you everyone so much for joining today. For those who don't know me, I'm Chris Lustrino, the founder of Kingscrowd. You can think of us as kind of the Bloomberg, Morningstar, S&P of the equity crowdfunding landscape. We've been tracking the Reg CF and Reg A equity and debt markets for the past 8+ years. And we've also raised millions of dollars from 5,000 plus investors to grow our own business. So very knowledgeable on the inner workings of all things Reg CF, Reg A, raising capital in these markets, thinking about going public post Reg A's, or utilizing Reg A to enable that. So if you're thinking about navigating these new landscapes, this is certainly a powerhouse crew to tell you all about it. So I'm going to let each of the individuals introduce themselves, and we should have one more guest joining us as well shortly. But I will turn it over to Mark to kick us off. Mark, would love to hear a little bit about your background for those who don't know you.
Well, thank you again for having me here today, Chris. I've actually, you said it spot on. This panel that you have assembled is first class. Jeanne and I have done deals together, which it's nice to be surrounded by top attorneys, and Gregg just joined us as well. By way of background, my name is Mark Elenowitz. I'm with Digital Offering. We are the pioneers of Reg A to trade on national securities exchanges. It was our methodology back in 2017 where we did the first ever Reg A onto the NYSE American. It was the first Reg A onto a national securities exchange, and we've gone on to do numerous offerings. Some of the big higher well-known offerings that we've done most recently was Newsmax, where we used a combination of Title II and Title IV and raised 300 million. And what was so special, it was the first ever Reg A onto the main board of the New York Stock Exchange. And we have several others that we're involved with now that will all be main board New York Stock Exchange, as well as several that are on NASDAQ and also the NYSE American.
Yeah, and Mark, I mean, very simply, you've done pretty much all of the biggest deals in our industry. Not all, but you've done most of the really big name ones to great success, and I definitely want to dig in on that. Jeanne, I want to turn it over to you. Give us a little bit of your background.
I'm Jeanne Campanelli. I've been with CrowdCheck it's been 10 years now. I think I came on board in
Wow.
2016 as we were starting to do the first Reg CFs. And I'm also a partner at CrowdCheck Law, which is affiliated. CrowdCheck works on disclosure and compliance for Reg A and Reg CF offerings, but we also do we worked with Mark and his team to help one of our clients, Nightscope, uplist using Reg A to get listed on
IPO, Jeanne, IPO was not an
IPO.
uplist.
It was an IPO. I'm being a technical lawyer. But and we had worked on, I think, 4 Reg A offerings for Nightscope prior to their IPOing. But we also do work on, right now we're working with one client that is also getting ready to become a reporting company with the SEC. But in my prior life before CrowdCheck, I spent 9 years working at a big law firm doing registered offerings, doing IPOs and bond deals and equity deals, both representing the issuers and representing the underwriters. And then I spent 9 years at Citigroup working with their equity capital markets and their equity trading desks, both in New York and London. At that point, I was doing all broker side deal, working with internal clients like Mark and people, investment bankers like him, to do other types of listings.
Awesome. And Greg,
Yeah, sorry to be late to the game here, but
no
let me
worries.
just give you my background quickly. My background is similar to what Jeannie's done, was on the legal side for about 25 years, working with companies going public, OTC, NASDAQ, NYSE, 34 Act work, 33 Act work. Back then did a lot of Reg A crowdfunding work to the extent that there was some back then. Mark and I go back probably 20, 25 years, Mark working on some China deals back in the day when it was a different world for China deals. Now in the last 6, 7 years, I morphed over from the legal side and work on the advisory side of working with companies looking to go public, whether it's through a traditional IPO, a Reg A IPO, a SPAC merger, NASDAQ merger, et cetera. I just think that the way the market has changed so much in the last few years, I think this model of using the way Mark's doing it, the crowdfunding, the Reg A to do IPOs, going after the retail with the institutions being hard to get done, with NASDAQ and New York Stock Exchange being the way they are. I think that the model here of using crowdfunding either to raise money privately and then go public, or using it like Mark's been using it as a way of taking companies public is honestly going to be the way you're going to see a lot of these smaller deals get done. Maybe not so small, Mark. I know you're working on some bigger deals. So, but I think that, and you can even just look at what SpaceX did with their retail, that you doing retail, bringing retail into IPOs is going to be a big part of what's going to happen over the next few years with the way the market's going these days.
Well, I think it all comes to kind of this very simple thing, right? Of we've now found ways of how do we aggregate lots of retail in, right? There was no effective channels in the past, and between securities law, technology, awareness, education, all of these things I think are combining to enable this. But you all mentioned in your intros lots of different things: Title II, Title III, Reg A, Reg CF, right? And I imagine a lot of folks are not fully in tune with all of those things. Starting with Reg CF and Reg A, Jeanne, can you just break down what each of those means, how we actually define those?
So regulation crowdfunding is the formal name for Reg CF. That the SEC instituted back in 2015 as a result of the Jobs Act that was passed in 2012. When it first kicked off, it allowed issuers to issue up to $1 million through a regulation crowdfunding offering. That's now been bumped up to $5 million. Regulation crowdfunding and Regulation A, well, actually, I'll start with regulation crowdfunding. When the SEC came up with regulation crowdfunding, it intended it to be a much more simplified and, as another colleague of mine likes to say, an easier lift for issuers to prepare disclosure and to be able to raise money. So the SEC has a very simplified rule set that, for those of us who are securities lawyers, you can tell is derived a bit from the type of disclosure requirements that the SEC requires for public companies that are far more rigorous. So the SEC even came up with a format where, if it's easier for an issuer, they can follow they file something known as a Form C, and they can either prepare disclosure in a way similar to the way you might for a public company, but on a very simplified basis, or you can either follow, you could even follow a questionnaire that basically allows an issuer to respond to questions describing their business, describing their risks, talking a little bit about their financials and their financial performance. The one thing that Reg CF does require that's probably a bit unusual to most issuers is it requires that you get either reviewed or audited financials. Actually, depending on what you want to raise, you could possibly self-certify your financials, or you can get them reviewed by an accounting firm, or you can get them audited. It depends on the level at which you're going to raise. But the thing that's very different that I think a lot of issuers will see in Reg A, Reg CF, and even when trying to get listed is they now have to create GAAP financials, generally accepted auditing procedures, accounting procedures. And that's probably the biggest difference between the type of accounting people are used to doing and what they would do for Reg A or Reg CF. Regulation A has been in existence since the Securities Act was formed or passed. It's been around since 1933. The difference was up until 2012, 2015, I think people were capped out at raising $5 million under Reg A. And now the SEC it morphed to being able to raise up to $20 million or 50 million, depending upon your tier. And now you can raise up to $75 million under what we call Tier 2 Regulation A. And in Regulation A, you must have audited GAAP financials, and the SEC has a somewhat more prescriptive set of rules for what you're supposed to disclose. Still a much lighter lift than if you want to be a public company, but that's the difference between Reg A and Reg CF from a disclosure standpoint. The other difference, the biggest difference beyond that is If you want to launch a Reg CF offering, you would just file your Form C. And the moment you file it, it's out there in the public. You can start raising. And we can talk a bit about the mechanics. Reg CF has a mechanic that's a little different than other ways of raising money. But then Reg A, if you want to raise money, you would file what's known as a Form 1A, and the Form 1A gets reviewed by the SEC in a very similar fashion to the way in which a registration statement for a public offering or an IPO would be reviewed. That was a lot of information, so I'll kind of stop there.
Yeah, no, and you know what? I'll boil it down for folks is if you are kind of a beginner, you're in an early stage company, right? Kind of call it anywhere from pre-Series A. Reg CF is probably going to be the best path for you, especially if you've never raised money online from the general public, right? From retail, because it's complicated. Even a Reg CF, many people I hear will be intimidated by the process because for the first time, you're filing real information about your business with the SEC, not just a form, but like your real financial statements, right? Who owns what of the business, right? Who are the board members, all of that kind of stuff. And it can be intimidating. And frankly, a lot of people don't even understand that. So Reg CF is perfect when you're getting started out and you don't need to raise a ton of money. And then if you're doing a really good job of raising Reg CF successfully, you've raised 5 million before, you've maxed out and you're looking to raise more, or you're just a more established business, you have a CFO, maybe you even have some internal counsel. That's when I think Reg A starts making more sense. But we still see many people kind of make the mistake of going down the Reg A path before they're ready. So Mark, I want to turn it to you again, having seen this so many times where people, I think, go down the path of Reg A when they're not ready for it. Can you talk about having really worked with many of the successful companies in the space? What is it that sets a company up for success? And what's kind of your advice to those folks who are thinking about it to say, this is when it makes sense and this is when it does not make sense?
So we use Reg A as an alternative to an S1. So I think the first thing an entrepreneur needs to do is look in the mirror and really decide if they're ready to be a public company, because your journey begins when you're public, not when you first start to raise the capital. And a lot of people think it's easy to be a publicly traded company and all these great things, and there's going to be this automatic ATM machine that constantly gives you cash. And the reality is it's very difficult to be public because you as the CEO are running two different companies. You're running your day-to-day business, and then you're running the business of selling your stock, getting people to focus and want to be a part of it. And that creates demand on you as the entrepreneur to be successful. And I think one of the misconceptions is that companies believe that being public on a story is acceptable when in reality it needs to be based upon fundamentals. So companies that we work with are consumer, entertainment, hospitality, large social media following, large iconic brands that want to give back. And I've been saying this since I think when Jobs Act came out in 2012, I went on my first webinar. And now so many people have taken my sayings. We are truly trying to democratize Wall Street and turn customers into investors and investors into customers. And now that's what everyone says, but that's exactly what Reg A does. So it empowers you as the entrepreneur to basically market directly to that consumer base that will hopefully buy your product as well as your shares, which will generate revenue and becomes a self-fulfilling prophecy. The reality, though, is a lot of that doesn't happen. And what we've seen is stories that have great ideas and blue sky where the CEO starts to drink their own Kool-Aid. And when you don't have a professional advisor around the table and somebody believes that flying car, that mini home, or whatever the new three-wheeled vehicle or solar vehicle is going to change the world, investors go and pay up valuations that aren't realistic. And then what ends up happening is when you come to Wall Street, you're judged upon your revenue, your earnings, and your growth. And if you don't have it, you're going to be punished. So we've seen a lot of companies come onto the market way too soon, and then within a year are gone. There's so many direct listings where they had to provide an exit because of a crowdfunding or a Reg A or some type of financing that were at these obscene evaluations where the professionals, including myself, try to get a short because we know they won't last.
Well, and just to hit on a little more, so I know you've helped clients to end up being listed, but are there occasions where you say, "Yeah, I think the Reg A makes a lot of sense for you," but you're still not ready for another year or two or three to actually IPO?
And that's the beauty of Reg A. And we've done this many times. Like Jeanne had just mentioned this company, and I scolded her and I apologize.
It's
But
okay.
this is my biggest pet peeve is I see so many people go on stage and call it the mini IPO. Well, my mini IPOs are bigger than almost every IPO in the small cap 1 billion market cap. So if I'm mini, then what is my competitors doing in traditional S1s? So that's the first thing. The second thing is it's not an uplist. An uplist is when you move from an OTC listing to NASDAQ or the NYSE. When you do a public offering, you're using a form of registration. What we've done is created the methodology to use Form 1A instead of S1, but our disclosure is to that S1 level.
Yes. I mean,
So
he's right. I mean, so the requirement is if you're going to, because you're going to wind up being listed, that's the one time on in Reg A, you are held to the higher standard that a public company would be held to. Yeah.
so
Sorry.
what we look for, no, that's good. Um, so your question was, what do we look for in these companies, right? I just
hmm
off top.
Right. When does it make sense to say, let's use Reg A and stay private for another 2 to 3 years
Right, that's
versus
right.
let's
Okay. Sorry
uplist?
about that. I got sidetracked.
No problem.
So, um, there are two examples where we've used Reg A. In fact, we've used every aspect of Jobs Act except Title One in order to facilitate a company's growth strategy. So a lot of companies we come to us and they're a little too early even for a Reg A, where they don't have their controls and procedures in place. And that's where Reg CF is perfect because
Yep.
they don't need to go through a regulatory review process with the SEC. They can go out. There's so many great Reg CF service providers that can help these companies market directly to their customer base, and they can raise up to 5 million to start growing their business. What they then do is they come to us, and unfortunately, we're kind of the firm of the land of no. People get frustrated with us with always saying no to issuers, but what we try to do is give them the appropriate advice where they can do a non-traded Reg A over a 12-month period where they're raising capital and having a closing every 2 weeks. We've done that now with two clients that did a CF. They then did a non-traded Reg A and they put the money to work where the fundamentals started to match valuation. And they came back a year and a half later to us, where we then did a public listing Reg A, where we then had the exchange listing. But we were coming out at a valuation, and really to be listed, you need something north of 200, 250 million and real generating revenue and earnings. And at that point, the non-traded gave them the tools, which is the cash, to execute. But most importantly, be able to handle thousands of investors. Because as I said, once you're public, you have these two businesses run. When you're private, you still have this responsibility. You have fiduciary responsibility to your investors, and you need to be in touch with them and communicate with them. And that's what a lot of these entrepreneurs don't understand. They take the money and then they go dark. You need to take the money and become very vocal. And because these are the very customers that will become your shareholders, that will become greater customers, and eventually become additional investors. And what we found with those two companies that we worked with, those investors actually bought more stock at a higher valuation because the CEO executed.
No, and a great example of that, a company that I'm watching right now is TerraCycle. And you could go to kingscrowd.com and look up TerraCycle and find their past raises and their current raise. Those guys, one, they continue to provide great investor relations to all of their investors from past raises. And then two, they've actually been paying a dividend, I think, every quarter for the past like 5 or 6 years, consistently. And they're a profitable company. So like they're leaning into it in all the right ways. You know, if you look at their revenues, everything, it's really, really interesting. And they've built it to be palatable so that when they do decide to, go public, that there's a real upside in it for everyone who's partaken. Anyway, just in thinking about like gold standard of doing things the right way, I've gotten to know them through my podcast and things like that. I have a lot of respect for the way they're doing it. Go look at them as an example of how to do it. And Mark, you're more than welcome to give examples of yours that have done it really well. Go ahead.
Yeah,
Yeah.
well, I have one that's going through the life cycle. I'm so proud of it. It's a company called Monogram Orthopedics. And
Yep.
Monogram did a Reg CF. They did a non-traded Reg A. They did a Reg A where we brought them public. We then did a follow-on Reg A, which I'm sure we'll talk about later, that we created this methodology to use Reg A for 34 Act issuers. Then we did an S3, or I'm sorry, we did yeah, we did it off S3 where we did another crowd financing. And then ultimately the company got bought out and went private. Investors were able to go through basically each stage of capital raising where the end result was the company became a success and then got taken over by another issuer.
I love that. No, it is a great example. Greg, I want to turn it over to you. We talked about, you know, then there's the going public part, right? For many investors, that's kind of the liquidity event. But for a founder, it's the beginning of a whole new journey. You help clients kind of go through these processes. Tell me a little bit about thinking about your readiness to go public, and then once you do, the components that maybe founders aren't thinking about.
I think, first of all, I think Mark touched on a little of it, which is, making sure they're well capitalized and set up and have a proper board in place. A lot of the companies that come to us, their first question isn't how do I get public? It's how do I access capital? And these days, accessing capital for smaller companies is hard. Everybody wants what we're going to call a bridge to get public. I think that the CF that Jeanne and Mark have been talking about is a great way to go. I mean, you can just do it the way Monogram just talked about. They don't all work that well, but do the CF, use that as your bridge to your Reg A, and then either do your Reg A once you're ready and you've built yourself up and you have the proper valuation to go public. But I think too many people don't understand that, what crowdfunding is, what Reg A is, and therefore they rush to the market. They're not getting enough money. They're not properly capitalized. They have to go back into the market way too quickly after they go public, whether it's through an IPO, Reg A, normal IPO, SPAC merger, and they're not capitalized well. And they don't know how to be a public company. They haven't taken that time. They haven't built up their board. They haven't done IR. They don't know how to do marketing. They don't know how to take care of the retail that Mark's talking about and Jeanne's talking about. It's one of the great things about a crowdfunding Reg A is you have your built-in marketing base right there. You have your consumers, your customers that should also be your investors and your shareholders. And that's, part of the beauty of doing a crowdfunding Reg A. And I think you're going to see more and more as these institutional deals aren't trading well and just honestly aren't getting done, more companies looking to this. But the first thing, going back to your original question, Chris, is really just getting ready. Do you have a good financial model in place? Do you have a good deck in place? Can you get your accounting done? How long is that going to take? Everybody tells me I want to be public as soon as possible. And I always say, okay, what does that mean? How long is your audit going to take to get done? Whether it's a PCAOB audit or a non-PCAOB audit, if we're doing a crowdfunding, but either way, we need to get an audit done to do pretty much anything we're going to do here in terms of raising capital, whether it's through crowdfunding or otherwise. So making sure that they have a good CFO in place, they have a good accountant or auditor in place. Most companies don't have it. Most of these small companies, don't have a CFO in place or even necessarily an accounting team, at least that understands GAAP financials and what needs to be done there. So making sure that you're ready to go before you go. And, Mark and I just talked to a company yesterday that's, probably too early. And I think the CF makes sense for them. And they have to get their house in order. All the stuff we just talked about, their deck needs to be worked on, financial model, et cetera. So I think that there's a lot that goes between you're here and then going public or even raising that initial capital.
Absolutely. And, just a few other things I've learned from doing this for 8 years, both watching nearly 11,000 companies doing this and having done it myself. There is like everyone thinks that like using crowdfunding is like the easy way to raise money versus going to venture or something like that. And like it couldn't be further from the truth. In so many ways, like if a venture investor wants to invest in you, it's the easiest thing in the world, right? Getting the yes is hard, but it's actually very, very easy. Trying to raise money under Reg CF, Reg A, it's incredibly complex. And what you need to know going in is like, it's a full stack effort, right? It starts with legal and accounting at a much higher degree. People always say, oh, I need the deal room. I'm like, if you looked at a Form C, there's more information in that Form C than I think I've ever seen in an actual deal room personally. But you have to disclose a lot of information in that Form C. In a Form 1A, you've essentially provided almost all the disclosures that a public company would. You were totally probed and provide all sorts of information you otherwise never would. You have your accounting where you're actually creating real financial statements, working with third-party CPAs. But if you're getting audited, you're going to have someone putting together your statements and then someone auditing your statements and asking you questions and asking for documentation. It is a far more intense process. And that's to get you to the start line. And if you haven't in parallel been prepping your marketing, your story, your videos, your all of your ad creative, your strategy, you're not working with great third-party vendors who are very, very good at doing those things, you're setting yourself up for failure. So this is like, from my perspective, Mark, you mentioned kind of doing this, a year-long Reg A. Like you are talking about setting yourself up for at least a 6-month effort where a good bulk of your time is going to be focused on all of the components of capital raising. And then, oh, by the way, once you've done it, all of the ongoing investor relations if you want to see the compounding effects of doing so. So, Jeanne, I want to turn it over to you. I just mentioned kind of there's all these pieces, but let's just talk about from a compliance perspective, timelines and what the process looks like for a Reg CF versus a Reg A.
Well, I mean, I've seen it. I have this discussion with different clients whenever they start to launch a deal with us and they've hired CrowdCheck to work on their disclosure. Um, there's a lot of assumptions here. I mean, if an issuer for Reg CF has, I mean, has their gap financials together and can, can respond to the types of we our process is one where we've created these questionnaires, both for Reg A and Reg CF, where we basically take the disclosure requirements, and it looks really daunting, but I think our questionnaires are largely 40 pages long. But they basically take you through the different parts of the document that you're going to have to provide information in and tries to drive a company to describe itself. Like a company that's really good at marketing itself many times is really good at preparing these questionnaires and responding to us and putting the information in. But it then also guides you into what documents do we need from a compliance perspective to look at and make sure, like we're kicking the tires saying, hey, do you really do this? Prove that you do this. Or if you're, number one in your business, prove to us you're number one in your business. A Reg CF, I've seen people able to, if they really have their act together, I'm going to say from start to finish, and this really assumes your financials are done, you could get one up and running in 6 months. I mean, that's right. I also, in Reg A, we have a similar, process. Um, I think back to the very first two Reg As I worked on, and I tell this story to a lot of people when they ask me this question. I started right around, I remember Labor Day 2016, and I had two different issuers. One who knew how to sell his company, knew how to describe it, knew how to market it. He did a phenomenal job answering our questions. We had him filed by early November. So, like, basically, it took us 2 months to put the disclosure together and to work with the company and their accounting team and their auditors and get filed by early November. We went through at least 2 rounds of SEC comments. And by Christmas Day of 2016, they were qualified, that's the word, and able to launch their offering. So that's fast.
Yeah.
I worked with a different company at the same time, started their document around Labor Day of 2016, and we didn't launch until February or March. Partly because we didn't even get filed until sometime in early, I think we didn't get filed until sometime like December-ish, and weren't able to launch until we'd gone through 2 or 3 rounds of SEC comments. So, I mean, I tell people to, from the moment we send them the documents to start responding to us, you know, we tell them it could take, by the time we get all the information, the most aggressive I've been is getting filed in 45 days. More typically, I tell people it's going to take 90 days from the
Yep.
time you get me the information to put your disclosure together. And then, the SEC review process, the SEC can take a month to review you. They issue comments. It can take you another week to put that together, another 2 weeks to hear back from the SEC. This can get iterative. I mean, sometimes you have to bake in, I think it could be anywhere from 6 to 9 months from the time you decide you're gonna, you start working with your team and get launched, right?
And that's
Yeah.
absolutely where like stacking, a Reg CF that's successful into a Reg A at some point. And I don't even mean into, but you're raising capital under CF and you use some of those funds to deploy towards the Reg A if you're having success, right? Makes sense because it is a far more extensive process. Mark, having been down the path of seeing very successful Reg A's that you've run, from a marketing perspective, like yeah, there's the fervent audience that just loves you, and maybe Newsmax kind of falls into that bucket. But with a monogram, I'm not sure there was just like that fervent following. Can you talk a little bit about the marketing and capital raising strategy within a Reg A?
Yeah, so there's a couple different ways to look at this. Like the very first Reg A that we did onto a national securities exchange was a company called Myomo. And Myomo was an exoskeleton robotic arm, basically company that took people that had various types of paralysis, and you could sense through the skin the ability to basically have the robot create mobility for
Hmm.
these patients. And our story was not around the offering, but around the therapeutic benefit. And we built a marketing campaign to generate interest for the product. But at the same time, when we showed people what the product could do for people, we then led them to the ability to invest. And that's offering was something I was quite proud of because they had no social media following. They had no patience, really, no visibility. And we used this to basically launch revenue for the company and launch growth for the company. And a year later, people were calling us up and saying how thankful they were that we were able to provide this benefit to either themselves or their friends or their family or loved ones. And it gave us a lot of comfort and knowing that we were able to make a difference. But that marketing campaign ended up generating this investor interest, and then it continued far beyond the offering.
Hmm.
So when you look at things, you need to first, in a perfect world, and some of the references of the deals that we've done had large social media following. Newsmax, I was able to go on air and I was
Hmm.
able to communicate to 20 to 40 million viewers per month. So we were able to get an enormous amount of, and for those of you that are listening, when we did the IPO, we basically sold it out in about 48 hours. We oversubscribed to 106 million from 30,000 retail investors. We had to shut it off and actually refund capital. But that's an outlier. Our other Reg A's require a marketing firm, and there are a lot of great firms out there. The beauty of Reg A versus an S1 is there is no quiet period. It's actually the opposite. You can be loud and proud. You can do webinars and record them and allow investors to come back. You can use social media in order to create visibility programs that drive people to a landing page. In our methodology, we encourage people to go to the landing page because they're going to be able to see the risk factors, all the things that could go wrong, on top of all the great things that could go right. And using these types of distribution points in order to drive people to a landing page to make an informed decision to make the investment is the key. And that requires capital. So when Greg mentioned bridge capital, you sometimes some of these earlier stage companies don't have the money in order to effectively run a marketing campaign. That's where going back to your question about being a non-traded is ideal because with a non-traded Reg A, you can take the capital on a closing every 2 or 3 weeks and redeploy a percentage of that back into digital marketing in order to continue the momentum and raise. When you do an IPO, there's one close. So you have to have the money up front. So an effective campaign is usually a 1 to 9, meaning for every dollar you spend, you're going to get $9 in return. A company on the low end that we would even consider would be a 1 to 4, 1 to 5. For every dollar, you get 4 or 5. Anything below that, you probably shouldn't be public. So doing a Reg A for an IPO, you have to have the money up front. You can't get it over a period of time. So if you're thinking of doing this, make sure you have a story that can be told in 30 seconds that someone's going to understand enough that they're going to want to learn more by clicking that link. If it takes 30 minutes to explain that molecule is going to cure cancer, you've already lost them. Even though it's probably an incredible opportunity, it's too complex. Keep it simple.
And Chris, if I could
And
just jump in there because we see
please,
it way,
Greg.
way too often, which is they have to be funded to do the marketing. If they don't, like Mark said, you can recycle it over time because it is an ongoing deal, not a Reg A IPO, but just a Reg A or crowdfunding. You can use that ongoing money as you release it. But if you don't have that initial tranche capital and think that you're going to be able to, raise do a Reg A, Reg CF without the proper marketing, then you're really just wasting the time and money you are for legal and accounting. You have to have that money there for the marketing, the initial money for the marketing. Like you said, then as it's successful, you can recycle that money, as needed. But you have to have that initial, because that's what usually happens. People come to us and they say they want to do this, but they don't have that initial capital. And then what? It's like, well, if you can't pay for the marketing, then we're just wasting our time.
Yeah, well, and just to make that real, right, Mark? You mentioned 1 to 9 is like really where you want to be. Um, Play that out, right? If you're raising $50 million, that means you need about $5 million to raise that 50 million. Some people will not be for that and think, oh, that's very expensive capital. What I do try and remind everyone on this call about is, if you go to traditional venture, right, they're going to take liquidity preferences. They're going to take board seats. You're giving up control. You're giving up, you have waterfalls that are going to screw up your returns when you go to exit. There's a lot about having the passive investor and the ambassador of your business that is deeply valuable. And I always tell people, don't think of this as acquiring them one time, because these people will come back multiple times if you do a good job of your investor relations. I've had people come in for singular thousands. I have one individual who did come in for north of 10K, who has now come in for over $400,000 into Kingscrowd, because I cared to reach out and say, hey, I don't know who you are. I'm really glad you're supporting Kingscrowd. Would love to get to know you better. And then built a relationship from there. You're going to have the opportunity to meet all sorts of people and build great relationships and build trust, even if you never speak to them, if you're doing a quarterly update and letting them know when big things happen, so that they want to come back and reinvest in you time and time again. We see nearly a third of companies come back and raise multiple times through Reg CF and Reg A. Greg, once you are kind of ready, you've maybe done a multitude of rounds of Reg CF, Reg A, you've set yourself up, you've bolstered your business, you are ready to go public. Talk to me about kind of that process of like selecting an investment bank and thinking about the right partners to be able to take that step as a business.
I mean, I think the part of it depends on, are you then, now that you've done the successful crowdfunding, is the next step to do a Reg A IPO or a traditional IPO? Do you even want to do, it's possible you might want, Mark talked before about a direct listing. If you, at that point in time, you're well capitalized, but you have a lot of shareholders and you want to go public, maybe you work on a direct listing instead of doing an IPO. But I think, if you're going to do a traditional IPO, then, who you bank the deal with is very important, because a lot of the bankers that are in the microcap space generally are just there to raise capital and don't do anything else, and they don't provide any aftermarket support. I think that's one of the great things about Mark. He gets so heavily invested in the companies that he's there to support them through the whole process of not just getting the IPO done, because Mark mentioned it before. That's just the first part of it. After that, you have 2 jobs and you have to make sure you have somebody focusing on both those jobs. But the fact that you can have a banker that can provide non-deal roadshows, research coverage, analyst coverage. So it's very important to make sure that you're talking to the right banker, that they handle your type of deal. There's certain bankers that are better at life sciences, certain better bankers that are better at tech, and there's certain exchanges. NASDAQ is better at tech, so it depends on which exchange you want to go to too, and how that fits. But certainly finding the right banker to not just raise the capital, but make sure that they can provide aftermarket support, because that's going to be key, is not having this company just drop off after they do the IPO.
100%.
Yeah,
And
let me just add to that.
please,
Just one thing
please.
about your question. So you had said something, $5 million, $5 million on raising a $50 million round. That's if you don't have a built-in social media campaign or a customer base or affinity
Sure.
group. And that's why some of the companies that we work with are larger, and they only spend a fraction of that because the customers want to become shareholders. But one important thing to point out is that and this comes with responsibility, it's more of an art than a science, which is valuation.
Mm.
And when you're doing a public round versus a private equity round, your multiples are higher than you would see in a private equity position. And you had talked about pref rights and other types of, um, I guess you want to say, control mechanisms that the investor puts into place, that while you think you're getting a better deal, there's a cost with each one of those types of incentives or agreements that you provide to that private equity investor. The beauty of using the structures that we've created for Reg A, when you come into the public capital marketplace, there's been a change. And what we've seen the change really occur over the last couple of years is offerings have now become investor driven rather than issuer driven. And what I mean by that is in the past, an issuer would get investors excited based upon the fundamentals and valuation. And what's happened now is the shift has gone where investors really don't care what the company does. It's all about what's known as structure. If structure means that the investor really won't lose money. So companies are coming public that are undercapitalized with structure, which means they're going to be doing a follow-on round. So if an investor invests high, they're going to be reset to a lower price. So CEOs don't understand when they give away unit offerings with shares and warrants, and they say, well, my stock will never go down because why would the investor ever sell the stock? The first thing that the investor does is sell the stock because he wants it to go down because the warrants are worth a lot more to him and it resets. So suddenly these companies are in a desperate situation. When you use the Reg A the way we do it, it's just straight common stock based on investors that believe in what you're doing. These are investors buying $500 to $1,500 to $2,000 of your company because they believe in you as the entrepreneur and they believe in the business. They don't believe in the flip and they don't believe in structure. So while you're paying up maybe for a marketing expense, you're getting a higher valuation and you're getting a loyal investor. And you said it, if you communicate with them and you execute on their business, that investor will be with you for life.
Yep. Well said. Jeanne, there's everyone gets excited about the capital raising part, right?
Yeah.
But then there's the ongoing investor relations. And a big component of that is the ongoing reporting. So talk to me a little bit about the requirements around both Reg CF and Reg A. What are the ongoing reporting requirements?
Sure. So the SEC, again, it clearly based its thinking on what public companies do. And right now, public companies report annually and quarterly. So there's an annual report that they have to file within a certain period of time after the end of their fiscal year, and then within a certain period of time after each of their fiscal quarters, they have to report. So they report 4 times a year. What the SEC then did, though, for Reg A and Reg CF was they stepped it down. For Reg A, you only have to report semi-annually. So you have an annual report due 120 days after the end of your fiscal year. And the SEC again made it, just to give you a comparison, if you're a public company, you've got typically 90 days after your year end. So if you're a 12/31, a December 31st fiscal year, if you're a public company, you have to report by March 31st. If you're a Reg A company, you have to report by April 28th. You get an extra 30 days. And then for Reg A reporting, you have to report your semi-annual financials within 90 days after the end of your semi-annual period. So if your semi-annual period ends June 30th, you have to report by September 28th. The SEC then stepped it down again for Reg CF. In Reg CF, you only have to report annually. You file an annual report 120 days after the end of your fiscal year. So the same, assuming you have a calendar fiscal year, which many companies do, you have until April 28th each year to report.
And if you don't have the reporting done, then it's my understanding that you cannot continue to raise utilizing those same rules, correct?
Right. Correct. So another key difference to encourage people to report, the SEC basically says if you don't report on time, you're out of compliance with Reg A or Reg CF. So let's say you missed that April 28th deadline I talked about. If you want to raise money again, and one thing we haven't really talked about, we've sort of alluded to it, is the $5 million I talked about in Reg CF and the $75 million that I talked about in Reg A, that's a rolling annual amount. You can continue to raise money, but in any 12-month period, you're stopped at 5 million in Reg CF, you're stopped at 75 million in Reg A. So let's say you're somebody, I'll make it easy, who wants to start a new Reg A. You've already raised, let's say, $20 million under Reg A. You want to start a new one because you like the way you did it. If you miss that April 30th filing date, you cannot file a new Form 1A. You cannot start a new offering until you get back into compliance and file that annual report. And we see that a lot, but thank you for asking that. That is one key issue. So the same happens in Reg CF. If you miss that April 30th or April 28th date I talked about, you can't start a new Reg CF. and maybe go to, so what might happen is, let's say you just raised $5 million and you want to go into a new offering, you can't try and raise another five if in fact, enough time has elapsed since the last time you raised 5 million. But that you have to stay in compliance. The SEC has a very different regime if you're a public company. You don't have the same issue.
And just a pro tip from someone who's done it many times now. If Reg CF is something you want to leverage and continue to leverage, you need to have your audited financial statements by April 30th of each year, 28th, whatever it is, the end of April. Because you're probably not going to want to step up and use a Deloitte or one of the large shops. You're going to be using a much smaller shop. It's very important that you pretty much put everything down for the first 3 to 5 weeks of your new year and make sure you get your accountants every piece of information you can about your business to make sure they can get your financial statements done as quickly as possible so you don't end up at the back of the pile of audits they need to do. Because I've seen many people that actually be stuck in the waiting queue for 2 to 3 months waiting for their audit to even begin because they're so backed up with the other deals that have already come in with their information. So just, in the planning phases, you have to think about even the small mechanics of how all of this works. Greg, one thing that I thought would be interesting to hear from you is as companies come to you and they're thinking about, going public, when you think IPO, direct listing, SPAC, so on and so forth, do you have some kind of like frameworks to help your companies think about when each one of those makes the most amount of sense?
Yeah, I mean, these days, honestly, most people are coming to us saying they want to do a NASDAQ merger, SPAC merger. I think they're being sold hard on the fact that these are quicker, cheaper options than doing an IPO or direct listing. But we'll take direct listing off the table because the truth of the matter is a direct listing really only makes sense for a company that's well capitalized, wants to go public or needs to go public like Spotify did, not to compare these companies to Spotify. But they went public through a direct listing because they didn't want the dilution of doing an IPO. So they chose, or the dilution of doing a SPAC merger. So they chose doing a direct listing. That is the real reason why companies do direct listings if they're already well capitalized but want to be public. So most of the companies that we're talking to in reality need to raise capital as part of the go public process. So, from there, it's a matter of figuring out, what is best for them. Is it, doing an IPO that raises them the capital they need, or is it doing a SPAC merger or NASDAQ merger? Let's just focus on SPACs for a second that are going to either have the money left for the non-redemptions or the company will do a simultaneous PIPE. So the first thing I have to get over them is the idea of the fact that doing a SPAC merger is going to be quicker than doing an IPO. At the end of the day, it's not. Depending on how long it takes to get your audit done, it's going to take you 9 to 12 months, probably at a minimum, to get any go public, no matter what, especially, depending on what the merger, what the audit time is going to take. It is not quicker doing an IPO and it's not cheaper. It's not cheaper doing a SPAC merger. If you do a SPAC merger, the legal fees are 2 to 3 times as much. The audits are the same. And of course, you're giving up a piece of your company for the value of your SPAC. It's really, the first part is educating them on the differences, timing, cost, and getting them understand that, notwithstanding the fact that they've been told that, they can be public in 3 months if they do a SPAC merger, that doesn't really exist. And then it's a matter of, okay, how much capital are you looking to raise? What valuation? Are they being realistic on valuation? SPACs, you can generally get a higher valuation, but that's not always such a good thing if you go in too high. Just like Mark talked about before with crowdfundings. I mean, if you do a crowdfunding when you're private, or Reg A when you're private, and the retail market, allows you to overvalue your company, eventually you're going to need to figure out a way to liquidate. And if you're going to liquidate in the public market, you're going to end up doing a down round, which never looks good for anybody. So really, it's an analysis of what's the best way to get it done right now, because the IPO market is difficult right now. NASDAQ is being difficult with smaller companies. More and more people are looking to SPACs. I think everybody knows the SPAC formation market is hot. I don't know about the SPAC merger market, but the SPAC formation market is hot. Everybody wants to form a SPAC because, that's a new vehicle, not new vehicle, but it's a vehicle for companies to go public. But it's really got to be done on a case-by-case basis and seeing what's best. And like I said, not to, preach to the people on this call, but the idea of using retail is just a great way to go. I mean, these institutional hedge fund IPOs that Mark was talking about that have warrants and everything attached to them, they don't end up doing well. To the extent that we can do a retail-based IPO or retail Reg A crowdfunding, and then maybe do a direct listing, something on those lines. But the more retail we can get in, the less structure the financing will be in the deal.
Oh, one thing I do just want to say, if you have any key questions, please drop them in the Q&A section. We'll make sure to try and get to them before the top of the hour. But Mark, I wanted to turn it over to you. One thing I have seen in our industry is, sometimes these companies go public who have done multiple Reg CFs or Reg As. And yes, there's the deeply overvalued companies. There's no doubt about that we see have a very hard time when they go public. But also, I think because there's been multiple different CFs that have gone public. I mean, we're probably in the territory of 30 or 40 now. There's jitter. We hear it from our own investor base saying there's jitters when a company goes public that what happened to the last one is going to happen to this one. So I'm going to just try and sell as quickly as possible. Is there things from a structure standpoint, or is it just a communication standpoint that you all kind of do to help manage any sort of serious selling when these companies go public?
Yeah, 100%. So, the first thing I think any company that's listening here today, make sure you have the appropriate counsel. And your counsel is not your IR firm or your promoter. Your counsel is actually people who come from the Wall Street that are going to reverse engineer you. And we take calls all the time from companies that are not going to be clients today, but they might be a client in 3 to 5 years. Because if your goal is to go public, you need to actually speak to somebody that understands the public markets. And that's important because when we first did Reg A back in 2017, there were a few issuer driven platforms that didn't understand Wall Street. And Jeanne, I think you were probably around at the time. I won't say any of these names. Some of those firms have merged and they're not in business anymore, but they were using these convoluted SPV structures and other types of structures that had they wouldn't even allow. In fact, you mentioned Nightscope. We had to go onto the global capital, the big market at NASDAQ because it was the cap table was so messed up
It was
from
complex. Yeah.
advisors who structured incorrectly. The one thing that I would say is in order to manage an orderly market is that you put an underwriter clause, basically that it's an underwriter lockup where we work with companies that have clean cap structures and the ones that come to us that don't, that have this in place, we can give investors liquidity where they can sell and take principal off, but they don't get to take it all off. Where sometimes a company might have done a 10-cent round, the stock's now $8 where we IPO, they're going to be the first ones to race to the door. They just hit a lottery ticket. But if there's an orderly way to do this, because we as underwriters, we're locked up 6 months. When we do private placements, the investors are locked up 6 months. The problem with a Reg A or a CF that's been held over 12 months is those shares, in theory, are not locked up and can be sold at any time. So there's unique, well, not really unique, but there is language that can be put into subscription agreements
Mm.
because if demand is there, we lift legends. And we lift the ability for these investors to sell because what we don't want to see, and we saw it with Newsmax, is Newsmax on the first day of trading or second day of trading with it $240. That doesn't help anybody. That's a bad thing. So had we released some of the shares in the private placement, now that there's a misconception. Everybody in the Reg A, the 75 million from 30,000 investors that bought at $10, every single one of those shares were able to sell, and some investors made a fortune. If it's done correctly through your advisor, it's a great way that you can also communicate to these investors. Going public's just the beginning. The damage that's being done in the market, the ones that you're referencing, are companies that have $3.5 billion valuations that did 10 million in revenue, that on a good day may be worth 20 or 25 million in market cap. Those are the ones you have to really think about and be the first one out the door.
Right. No, 100%. Just so you all know, we will be having a follow-up email go out right after this. If what I've tried to do here today is paint a very realistic picture of this landscape, not the, hey, come raise 5 million or come raise 75 million, but what does that actually mean? What are all the challenges? And if you walked away from all of this being like, I still want to do it and it all makes sense and I'm down to buy into the whole process, that's great. I'm happy. If you were scared away, I think that's just as valuable a service that we've provided
Mhm.
here today. Be like, hey, this isn't the time, or I'm not ready. But if you do want to talk to any of the individuals on the call, Connor, who works with all of our clients, will have his email go out, Connor at crowdcheck.com. And we're happy to just be consultative, A, to make intros to any of the individuals here or make sure, hey, yes, now is the time that maybe you want to chat with them. And B, just be a resource as you think about Reg CF, Reg A, all of these things, because there is so much to think about. And we have scratched the surface of all the pieces involved with this. So it's not for the faint of heart, and it's not something you should just wake up and decide, you want to do. If you want to do 124K Reg CF where you have self-certified financials, probably not, a terrible thing, maybe worth a shot. But if you're thinking bigger than that, you want to go for a full $5 million CF or a full $75 million Reg A, now we need to talk and we need to think through that. So we will be following up so that we could connect you with any individual you'd like to kind of explore and dive deeper on kind of what this process all looks like. I do have one question being dropped in here. Will this be recorded? Yes, it is recorded, and we will be sending this out to everyone in like the next 15 or 20 minutes so that you have access to it to watch back. Last thing I want to do here is just give everyone a last word before we sign off. Jeanne, I'll start with you.
Last word. No. So one thing I've noticed, I mean, I know, Mark, you talked a lot about the kinds of companies that you have found successful at doing this. I found the clients that have been most successful are people who either one already, and I know this reiterates it, already have some sort of following. Like I had one client that was an online athletic wear retailer. They already had a built-in email list that they could start marketing to. Same for an online wine retailer. They had a phenomenal time raising money. Where I find some companies, and Nightscope, for instance, I think did really well, even though their product was not one that anybody typically, they weren't something you could order online. They made security robots. Um, their CEO was a great marketer. I mean, to your point, Chris, and I've seen this, he knew how to go in marketing mode and how to be in CEO mode and to do it at the same time. Right. Other
Yeah.
times I've too often seen people where, I mean, I'm just the lawyer, but um, they just don't know how to do both at the same time, and it does drag out.
100%.
Especially if they're a small company. So it's a complicated process. CrowdCheck, we've been doing this now, I think 12 years since the company was formed. Um, you know, we um, we know how to hold your hand and take you through it.
Awesome. Greg.
No, I think, the message should be that this is definitely an avenue that is available for the right companies that have the right customer base behind it. But I do think, that, and I might start steal some of Mark's thunder here, having the right advisors is really important. If you're going to go out in overvaluation or you're not going to be properly capitalized before you do this, then it's not going to work. So you need to be talking to the right people to make sure that this is set up properly, structured properly, valued properly, not just to get this offering done, but to make sure of whatever your exit plan is going to be in the future is well capitalized and set up.
And Mark, I'll give you the last word.
I think the best thing to think about is the things we discussed today are basically different tools in your tool belt. You need to figure out where you are in your evolution and what tool to use and pull out of that belt. And then once you pull it out, whether you're going to do CF, we didn't really talk about private placements, 506C, or you're going to go with Reg A or eventually a public listing. I cannot reiterate enough, and you've got two advisors on this call, Jeanne and Greg. Make sure you bring together your lawyer, your marketing agency, your accounting firm, your financial advisor, and then depending on where you are, ultimately an investment bank, but someone that's done it before. Just because you have a license doesn't mean you know what you're doing. Those are going to be your team members that will ensure that they will give you the advice you need to navigate all the pitfalls, and most importantly, to allow you to be successful. Because if you do this wrong and you take your customers' money and lose them money, you've now lost a customer and you've lost that revenue. when if you do it right, the customer will continue to generate revenue for you and continue to grow your business. And it's a win for everyone.
Thanks, Mark. Look, I think being on this webinar is the first right step in all of this, right? You're getting yourself educated, get yourself educated. And then I'd say once you decide, okay, from my education, I do believe I'm at the right juncture to take the Reg CF step or the Reg A step or whatever it may be, then fully commit to the process with the right people around you, as Mark mentioned. This has been a very insightful conversation. I can't thank you all enough for being here today. I sincerely appreciate your time and your insights. You're some of the best at what you each do in the industry. So really, really appreciate your time. Thank you to everyone for tuning in and for your questions and thoughtful listening. Like I said, we will send a follow-up email, and please do reach out. We're happy to be consultative in nature and just helpful and help you try and figure out how to navigate these waters the first go around. Or maybe it's your second or third time down the round. But thank you so much. Have a wonderful day, everyone. And we look forward to seeing you on future discussions. Take care now.